Hi, I'm Barry Green with Barry Green Homes. Before we get started, I want to mention that I am a real estate agent, not a mortgage broker or loan officer. Loan programs, interest rates, guidelines, and available funding can change over time. Always verify current information with a qualified mortgage professional before making any financing decisions. If you need a referral to a trusted mortgage broker, I'd be happy to connect you with one. Today, I'm going to walk you through the key financing concepts every first-time home buyer should understand before purchasing a home. Let's get started. One of the first things you'll hear when shopping for a mortgage is the difference between an interest rate and an APR. The interest rate is simply the cost of borrowing money. A PR stands for annual percentage rate. A PR includes the interest rate plus many of the fees and costs associated with obtaining the loan. Think of it this way. Two lenders may advertise the exact same interest rate, but one lender may charge higher fees. The APR helps reveal the true overall cost of the loan. When comparing lenders, don't just compare interest rates, always compare APR as well. Next is something called DTI, which stands for debt to income ratio. This is one of the most important numbers lenders evaluate. Your DTI is calculated by taking your total monthly debt payments and dividing them by your gross monthly income. For example, if your monthly debts total $2,000 and your monthly income is $6,000, your DTI would be approximately 33%. Generally speaking, conventional loans often require a DTI below 43%. The lower your DTI, the stronger your loan application may be. A lower DTI can also improve your buying power and may help you qualify for better loan terms. Your credit score can have a major impact on both your interest rate and your monthly payment. Generally speaking, a FICO score of 760 or higher often qualifies for the best available mortgage rates. A score between 700 and 759 is still considered strong. A score between 660 and 699 may still qualify, but often results in slightly higher rates. A score between 620 and 659 is generally the minimum range for many conventional loans. Below 620, FHA financing may become a more realistic option. Even a small difference in interest rate can add up to tens of thousands of dollars over the life of a mortgage. That's why protecting and improving your credit score before purchasing a home can be extremely valuable. Let's discuss the three most common mortgage programs. Conventional loans. A conventional loan is a mortgage provided by a private lender and is not directly backed by the government. These loans are typically best for buyers with stronger credit profiles. Most conventional loans require between 3% and 5% down, although putting 20% down eliminates PMI, which we'll discuss in a moment. Many conventional programs require at least a 620 credit score. FHA loans. FHA loans are insured by the Federal Housing Administration. These loans are popular among first-time home buyers because they allow lower down payments and more flexible credit requirements. Many FHA borrowers can qualify with a credit score of 580 or higher and a down payment of just 3.5%. VA loans. VA loans are available to eligible veterans, active duty military members, and certain surviving spouses. This is often one of the best loan programs available because it may allow 0% down payment and does not require traditional mortgage insurance. A one-time funding fee may apply depending on eligibility and circumstances. Let's talk about PMI. PMI stands for Private Mortgage Insurance. PMI protects the lender, not the borrower. With most conventional loans, PMI is typically required whenever the down payment is less than 20%. The good news is that PMI can often be removed once sufficient equity is built in the property. FHA loans use a similar concept called MIP, which stands for Mortgage Insurance Premium. Unlike conventional PMI, FHA mortgage insurance often remains for much longer and may last for the life of the loan depending on the loan structure. One concept that surprises many buyers is amortization. When you first start making mortgage payments, most of your payment goes toward interest rather than principal. As time passes, that balance slowly shifts. More of your payment begins reducing the loan balance and less goes toward interest. For example, a $600,000 mortgage on a 30-year loan can result in hundreds of thousands of dollars of interest being paid over time. Understanding amortization helps explain why reducing your interest rate and making extra payments can have such a powerful impact. One strategy I often discuss with buyers comes from Dave Ramsey's approach to reducing long-term mortgage costs. If you choose a 30-year fixed mortgage, consider making one extra mortgage payment each year if your financial situation allows. According to examples in my guide, this simple strategy can save approximately $180,000 in interest and potentially shorten the loan by more than 7 years. Of course, every situation is different, so discuss strategies like this with your financial and mortgage professionals. Many buyers ask about down payment assistance programs. Programs such as Cal HFA, Dream for All, and various city and county programs may be available depending on your qualifications and available funding. Rather than cover those in detail here, I've created a separate video called How to Buy a Home in Los Angeles with Little Money Down. I encourage you to watch that video next. Buying a home can feel overwhelming at first, but once you understand concepts like APR, DTI, credit scores, loan types, mortgage insurance, and amortization, you'll be in a much stronger position to make smart decisions. If you'd like a referral to a trusted mortgage professional, feel free to reach out. I'm Barry Green with Barry Green Homes. Thanks for watching, and I look forward to helping you on your path to home ownership.